Howdy, lieutenants and economists.
The most volatile, evil, disgusting things on the planet, humans. If you have a video request, you can always go to assholeconsulting.com.
Yeah, I am gonna charge you, kids. And that is the importance of not fucking up.
You are such an asshole!
Hey all, Captain here. I'm in week 2 of being sick. There hasn't been a lot of posts because I have been that weak and tired. But I went into the doctor, and I do not have strep, which kind of sucks because that would be a solution now, wouldn't it? I just have to endure this. Anyway, got a video request. Hey Aaron, I'd like to get you to do a response to a video by RawDogLetard entitled Ultimate Protection, Fixed Debt Against Hard Assets, and if his advice is sound given my situation. Rundown of my situation: house paid for, 6,000 square feet of land paid for, 15 ounces in gold, 250 ounces in silver, 10,000 cash, 6,000 of which is my rainy day fund. So given my assets, would it be a safe scenario to perhaps take out a home equity loan in the minimal amount of $25,000 so I have sufficient capital to develop my land? Okay, so let's leave there. There's no reason to go into more details because he wanted a separate request for additional detail beyond this request. So I watched it, and I wish I didn't, because the guy isn't necessarily wrong. He's really loud, and I'll put the link down below. And in some things he's right, and other things he's not, and he's all over the place. And so I'm going to focus on two main things, or the main premise of his video, tell you what I think about it, and another aspect of it that I think he's just dead wrong on. But in general, he's kind of right, but I don't think he really has fully thought through all the economics, understands all the economics. In other words, he doesn't strike me as a guy who studied economics. He strikes me as a guy who listens to a lot of Alex Jones and is slowly piecing together a model that sort of works, but it's really simple, but he operates from all these wrong premises. So, fixed debt, again, shows you, okay, what's fixed debt? Fixed debt is short-term structured debt, or not short-term, it's fixed interest rate debt. I don't know, fixed debt, but he also seems to talk about it in the context that it has to be attached to something. So let's get the nomenclature right. You're talking about fixed interest on an asset that is income generating, okay? And I think, and he didn't even talk about, that's the one thing where I was like, what are you just flapping your gums or what? So let's talk about what debt can and cannot be used for. Debt can be used for anything. You can use it to, you can borrow money at various maturities and interest rates and use it to purchase different things. Now, usually, some types of debt are structured for certain types of purchases. A 30-year mortgage is obviously structured for the purchase of a house, and you pay back in 30 years. A car loan is for a car loan, and a student loan is for stupid millennials who think that they're smart and that a little piece of paper in the liberal arts is going to guarantee them something. Ignoring how the debt is structured, let us talk about the two general type of assets that you can purchase with debt or cash, doesn't matter. There's income generating assets, which are investments, okay? Things like stocks, they pay dividends. Rental property, that generates rental income. Your own business, trucking company, for example, it generates income. So you buy a truck and it generates income, right? Those are much better to borrow money against because they have the potential to generate the income to pay not only your interest and principal back, but leave a little bit of profit left over for you. And that's the whole idea of capitalism. You borrow capital at a certain rate, you invest it, and you get a rate of return that's higher, and you make money. The other type of assets are consumables, goods, services. A bankrupt, that does not generate income. It's a service. A McDonald's Big Mac, food, that does not generate, necessary, but it doesn't generate income. Those are non-investment assets. And what this guy, his general premise was that he didn't believe that gold and silver would be a way to make money off of the collapse of fiat currency system. He said that the prices would not go up enough that gold and silver would buy more than what they would previously, and we don't know about that. I disagree with that, but we'll get to that secondly. And he's saying that the only real way is to have fixed debt, term is still throwing me off, against some kind of asset. And his point was that the inflation would eat away at that debt. Well, what he never followed through with is, what do you do with that money once you borrow it? And I don't know if he just meant it was implied or like you just assumed that was going to be going into an investable asset. But he never said that. And so that's the one thing that I want to point out is you can't just, it almost sounded like he says, well, get debt. Get really low interest debt and just have it. And then when the currency collapses and it hyperinflates, you use hyperinflated dollars and, a fixed asset so that it wipes it out. Then you made money. And it's like, no, you don't understand. You borrow the money, you still have the money. You got to do something with it. Like if I go out and get a line of credit, in this guy's case, let's say for $25,000, I can't just say, yay, I got money. I have to put it into something so it'll generate a profit, generate some kind of income for me now and into the future. And what's great about assets, and this is why I recommend at least investing a little bit in the S&P 500. I know that the U.S. stock market is overvalued. I know that. But what drives the value of stocks is not earnings in the past, it's earnings into the future. And those earnings, unless you're in a very odd type of industry, will naturally inflate along with inflation because businesses have to generate the profits and they'll raise their prices as their input prices go up. They will raise their prices, and that's why we have inflation. That's why the cost of goods are more expensive. And so you've seen this a couple times, I think, in the Zimbabwean stock market, the Venezuelan stock market, other places where there's been inflation, hyperinflation, the value of stocks have gone, I can't even say value, the price of stocks have gone up, not because their earnings have gone up that much, but because their future earnings naturally are a hedge against inflation. So that's an example of investing in an investable asset. And in your case, I think you want to grow crops. Okay, again, that would be an investment that would be naturally hedged against inflation. So you have to take your money, you have to do something with it, because then it's going to be, it too will inflate away. So you got to convert that into something. Now, you can go ahead and put in gold and silver, which are non-investable assets. They're technically commodities, and they don't generate dividends or interest income or rental income. But they are sort of an insurance. And then, of course, you can go ahead and invest your money in an investable asset. I don't know how many of us, though, want to start our own company or have that ability or have that opportunity. So silver and gold then make, for the common man, a good hedge against inflation. So I hate to put words in this guy's mouth, but I didn't really understand his video. But it seemed like, yeah, just get debt, and that's your insurance against inflation. It's like, okay, but please do something with the money while on top of it. So if you don't want to run a company, you don't want to run a business, you don't really like the valuations of the S&P 500, you don't like the stock market, for the average person, it's worth it to have some of that money in gold and silver. Now, would I borrow $100,000 and put it into gold and silver? No, I would not do that. Would I borrow any money just to take a position in a commodity that doesn't generate income or dividends to pay the interest on the debt I'd have to pay? No, I'm a very conservative type individual. But where I also disagree with this guy is he's like, well, gold and silver, and he thinks it's going to be this big ass huge collapse and it's going to happen like that. I'm aware that at least in the U.S. we have the world's reserve currency. It's going to be more of a slow decay, which is what it's been so far. So I don't believe our money is going to go poof overnight, at least the U.S. dollar. I think it'll slowly erode as it has been. But if it were to go poof, we were to have this economic collapse, I do believe gold and silver, as it always has done, will roughly maintain its purchasing power. Now, of course, it goes up and down, and he could be right at one point where gold and silver don't go up as much post-collapse to maintain its traditional purchasing power. It may go up above that, but I actually believe that gold and silver will, especially during and after a crash, it will go well above its traditional purchasing power, simply because, and I've done the numbers on this, if the currency, like if fiat currency is to be wiped out and we take what remains of the world's global production, and we use the world supply of silver. I use this on silver. I think silver goes up like, what was it? Anywhere between 20 and 75 times its value. Like, I mean, and it has all these assumptions. And the truth is, nobody knows. At least I tell you that. This guy, no man, it's going to go down. It's going to crash. He sounded like a guy on one of those sports football games. You know, dude, if the Patriots don't know what Tom Brady's going to do, it's going to go down, man. You don't know what the Pittsburgh Penguins have going on. You put Tom Brady in there. He's doing the goalie thing in the fourth quarter. I know I mixed up sports balls. Anyway, where was I going? So at least I have a little bit of research and numbers on it. I think this is why I tell people, like, take the amount of money that you want insured with silver and divide that by 20, and that's how much in today's dollars, because I'm erring on the side of caution. So I believe it would at minimum go up 20-fold. Somewhere around 50 times, and on the high end maybe 75-fold. But again, it depends on how much production there is. You know, does the world, all of it, really revert back to silver and gold and precious metals for currency? We don't know. So that's it. I mean, he's right, but I don't know if he even knows why he's right. But yeah, the key thing I would just add to it in your particular case, and you're doing this, you're taking your money and you're going to invest it. You're going to generate income with the money you borrow, and that's kind of the key thing there. Because your debt gets wiped out. Like, you don't have to pay off your debt; you can just service it. You can just pay the interest. The debt would get wiped out by hyperinflation. You take your $1 trillion bill and you pay it all off. And then after that, you have your little farming there, your 6,000 square feet of acreage generating vegetables or whatever, and you got that for free, more or less. You had to pay interest on it. So yeah, please, that's the key thing I would add to his video is you got to make sure you purchase an asset that's an investment and generates income more than what the interest costs are on your debt, and that's about it. So hope that helped. Toodles.